Hi everybody, welcome to another edition of Stock Talk. This is episode 22, and my name is Aman. I'm an investment coach here at Sage Investors, and today I want to talk a little bit about fiduciary duty. I know, a couple of really big fancy words. Fiduciary duty got a lot of play in the States this week as the government came out with some guidelines and new guidelines with respect to what financial services companies, specifically getting down to financial advisors, people working in that industry, have to carry themselves by when they're working with their clients. And part of it revolves around fiduciary duty. Now, for those of you who don't know what fiduciary duty is, I'll try to make this as simple and basic and painless as possible. Basically, as a financial professional, or any kind of professional, really, it doesn't really relate to financial services. It can relate to any legal profession, medical profession. You're owed. The concept is that you, as a professional, owe your clients an element of fiduciary care, a fiduciary duty to basically look out for their best interests. So when you bring that down into the investing or financial advice kind of realm, financial advisors really should be obviously looking out for their best interests of their clients, in the sense that they should be, when they're in the business, get to the point of recommending certain products, investment products or investment vehicles like stocks or bonds or mutual funds, ETFs, bond funds, that they're recommending funds, products that are in the best interest of the client. It's not about just, well, here's a product here that you go try it out, and oh yeah, by the way, I make 4% commission on it. And that's really what, fortunately, I hate to say it, but that's what financial services is all about. It's all about pushing products, about sales, about commissions. And a lot of times when you're working with financial advisors, it's really, they're more interested about the commission they're going to get off you rather than really genuinely trying to help you meet your financial goals. And then the other side of it also is this whole fiduciary duty is trying to be open up more transparency in terms of how much fees customers are paying for various financial service advisory type services. And right now the whole concept is so opaque. It's a lot of it is embedded in terms of the prices you pay, the fees you pay, and you really, as an investor or as a consumer, you really don't know what you're paying for getting financial advice, and you'll be shocked to hear how much financial professionals get paid. And so this is the whole thing. It's come out, and of course the financial service industry hates it. They're not fans of this at all. They like it the way it is. They like the opaqueness and lack of transparency of it. I can't really blame them for it. And I think one of the issues that they're talking about is that the whole industry is just going to cave, and that you're going to see thousands upon thousands of financial advisors just walk out the door and say, you know what, it's not profitable for me anymore to do this. If you're saying that I have to force myself to now sell products or recommend products that are lower commissions for me, that's just going to make me unsustainable as a business. And all this other nice stuff they do, doing investment plans and financial planning and debt management and developing budgets and all that stuff, is just not as lucrative as just charging somebody 2% a year just to do nothing, really. So interesting enough, those new guidelines came out this week. And not surprisingly also is that those guidelines were actually much more watered down than a lot of people feared. And big surprise, the financial lobby got really hardcore into this, and obviously got some influence into this. And a lot of the guidelines that came out there seem to be a lot more restricted, and they've pushed out the deadline to implement a lot of this stuff. So it wouldn't surprise me to see, I think 2018 is now the deadline now to embed a lot of these guidelines into financial advisor practices and financial services industry. So I'd be surprised to see, and what's actually happening up here in Canada, because there's a new set of guidelines coming into play in June here called CRM2, which basically forces mutual fund companies and financial companies, that people that are selling mutual funds, to kind of disclose the fees they pay and actually put a breakdown, itemize the costs that an investor is paying. So when you get your quarterly statement or your annual statement, you're going to see a breakdown of how much that you're paying for fees to hold these particular funds. And the big thing is once people start seeing, because everybody traditionally thinks, I'm not paying for this. I'm just putting it in there. I just put the money in, and it's, somebody's paying for it, but I'm not. The reality is you're paying, each and every one of us, when we engage in the financial services industry to buy or sell products, we're paying fees, we're paying commissions. And a lot of times over the long term, the more you pay, the more it's going to eat into your return, and the more or less you're going to have down the road when you get near your serious milestones. So that's coming up here in Canada, and there's going to be a big outcry. And already you're hearing rumblings of like a lot of financial advisors just stopping, just shutting down and going and selling other products that don't fall under that umbrella of CRM2, like insurance. So don't be surprised if you see your financial advisors now pushing insurance products in your direction, because they don't fall under this umbrella, and they obviously carry higher commissions in that sense. So something to look out for. My take on it is, anything that's transparent for us as consumers is a good thing. I want to know how much I'm paying for any kind of product, and having that transparency is not a bad thing, because it promotes competition, and it starts forcing companies to really justify their value system. In a sense, I'm kind of looking at it also from a different perch in the sense that I'm an investment coach. I don't give advice. I teach people how to invest. I teach people how to make better decisions. I teach people how to navigate through this rivers and valleys and of the financial services industry, because the reality is the financial services industry is not going away. It might exist in a different form with technology, robo-advisors and all that stuff, but it's not going away, and you still have to maneuver through it. And I spend most of my time teaching people and coaching people how to maneuver through it, how to even work with their current advisor, how to get more out of their financial advisor, instead of it being just like a one-way conversation where they're just pushing product on you and just trying to generate sales. I really believe, I don't want to bash the financial advisor people, because they do serve a purpose. I think they have a value proposition, and that value proposition to me is about execution of strategy. I think they have the scale, and they have the capacity, and they have the intelligence and the competency to execute strategies. They can formulate strategies, but I think where we lie is the execution of the strategies. So a lot of times, like for example, if I say I want to build a portfolio of ETFs, Canadian, U.S., I should be able to go to my financial advisor and say, you know what, this is what I want to do. Go build it. Go do it, and do it at the most cheapest, reasonable way possible. And they should just go and execute it. If I'm looking for research, if I'm analyzing companies or if I'm analyzing ETFs, they should be able to execute that strategy. They should be providing me that kind of information. And that's kind of one of the dilemmas I really find in that traditional financial advisory model, is that it's conflicted. You're in there talking about giving people advice, but the next thing you're doing is you're selling a product to help them get to their financial goals that may or may not be in their best interest. It may not be the best product out there for them. It may be the best product out there for the advisor, because they might be getting more commissions out of it, but it may not be the most appropriate product or an investment vehicle for the client. And to me, this whole financial advice model is kind of flawed, in that it's got that organic inherent conflict of interest, and that's the thing why I never even bother going down that route. And what I love about what I do, because as an investment coach, I don't tell people what to do. I don't tell people go buy this ETF or go buy this stock because I said so. I say or because I'm going to get paid for it. I don't get paid for it. I get paid for my time to teach people, to mentor people how to make those decisions so they can make it themselves. And that's the beauty of it, is when people make it themselves, they own their destiny, they own their direction, they own their path, and they're going to probably make better investment decisions because it's theirs and they own that whole concept. So, I can understand why the advisors would be pretty pissed about it, but I think it's about what works for the client. As I said, I don't think financial advisors are going away. I don't think the profession is going to collapse and cease to exist. It's going to exist, but it's in a different form. But what's really important for people like you and me is how we interact with that system. And one of the things, as I said, I do is I coach people how to work with their advisor, financial advisor. And it's about formulating a strategy. And really what you're trying to do is trying to build a relationship, develop a positive relationship with your advisor so they can execute the strategy you need to do. And a lot of it isn't just about telling people what they should do and looking like a big shot or anything. A lot of it is just simple developing a business relationship. And how do you do that? It's just presentation. Just don't walk into a meeting with an advisor wearing flip-flops and shorts and a Bermuda shirt or a Hawaii shirt and kick your feet up and say, hey, I have $50,000. I have no idea what I want to do. Help me out, because you're just giving them a blank check to sell you all kinds of garbage. It's about proper presentation. You're going into a business meeting, right? So look like you're serious, because if you walk in looking professional, and I'm not saying wear a blue suit, but I'm saying just look clean and professional, they're going to take you seriously. It's body language. Body language plays a role in how people perceive you, and if they perceive you as coming in very prepared and that presentation, they're going to take you seriously, and they're probably going to not go down the road. Other elements that I talk about, that I work with people about preparation, just like having a notebook in here, having some questions prepared, having an agenda written down, so you just don't go into a meeting cold and say, okay, I have to talk to my financial advisor because nature dictates I have to talk to my financial advisor. It's January, start of the new year. No, you should come into every meeting you meet with an advisor with some goals, with some things you want to come out with. And if they can't answer it, to put their foot to the fire and hold them accountable to find the answers that you want. So preparation is an important part. And then just how do you undertake the conversation? When they're talking to you about different, because they're going to pitch you on different investment products and mutual funds or different types of ETFs, well, you need to have that conversation around those products need to involve three things. They need to be talking about how it impacts you from a debt perspective. Is it, analyzing, they should be constantly checking out what your debt situation is. If you're carrying a lot of debt, is there a strategy that they should consider before investing in something? That whole conversation, we work on stuff like that. Risk. It's amazing how many times you go into a conversation with a financial advisor and the concept of risk is the word's not even mentioned. And it's interesting because CBC did an undercover study with a bunch of people walking into a bank and a financial services companies, asking them about different products, and so they had $10,000 to invest or whatever, and they pitched these guys and these ladies and gentlemen, they pitched them on these different products, but they said can't win proposition, guaranteed moneymaker, nothing about risk, which is insane. Any investment decision you make has to factor in risk. And a lot of times advisors don't do it. So I prepare people going into those meetings, talk about risk. What are the risks associated with me going and buying these products you're recommending me? That side of it. Fees, having a conversation about fees, asking the advisor, how much are you getting out of this? What's your cut of this deal if I go buy this mutual fund? What's the cut of how much am I paying into this? CRM2 here in Canada and the fiduciary standards and all that's supposed to clear that up, but hey, you still bring it up in a meeting. And so I asked them, asking questions. And at the end of it all, having an action plan. After you talk about certain products and strategies and stuff like that, having an action plan, holding the advisor accountable to executing your strategy. And that's a critical element too. And so, these elements, I'm sure advisors don't want to hear about it, but the good ones actually will follow all these things and will be able to answer these questions and take you seriously. And so, it's just a matter of finding them in that sense. So, that's kind of just my take a little bit on the whole fiduciary standards thing that's kicking in now and getting a lot of play, a lot of press out there, as well as just my whole take on the whole financial advisor model and really how to deal with them. Hopefully it'll give you some tidbits. As I said, I work as an investment coach, and I spend time prepping people on how to deal with these things. So I thought I'd share with you that other element of investment coaching that's very different than what the traditional financial advisor model does, because the financial advisor model will not even go there in terms of the whole education side, because it's not in their interest, because the last thing they want is to have informed people coming into their office telling them what to do. And they prefer to have people to be less educated, because then they can put more products out on the table that might be to their benefit. And so this whole fiduciary standard concept is meant to kind of say, you know what, I don't want to go there. These are the products that are really in your interest. They may not be the most effective for my business, but it's about what's in it for the client, what's the best interest for the client. So that's all I got for you. If you have any questions about this or any other things that I've talked about in the